Hello, and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Levinka. Today we're going to talk to you about the ins and outs of VA loans, one of our favorite loan programs here. It is a really, really great program that is exclusive for veterans.
It is. One of the best parts about it, it's a 0% down loan.
It's very good.
Absolutely. So there is no down payment with a VA loan. With a VA loan, a couple of the other nice thing that it's zero down is you don't pay monthly mortgage insurance. So like a conventional loan where if you don't put 20% down, you're going to pay mortgage insurance, or an FHA loan where you're going to pay PMI. On a VA loan, you do not. But however, you could potentially pay what they call a VA funding fee. So if you're currently in the military right now, and are not receiving any disability, and if you've never used a VA before, you would pay a VA funding fee of 2.15% is what that looks like. But if you have used your VA before and you want to use it again, because the VA does allow you to use your VA more than one time. As a matter of fact, depending on certain areas that you live in, VA has higher loan amounts and will allow you to have more than one VA loan at a time. But when you use it again, it's 3.3%. However, when you got out of the military, if you received 10% disability or more, the VA funding fee would then be waived at that point.
Absolutely. So even though you do have to pay this funding fee of if you're not exempt of 2.15 to maybe 3.3% if it's a subsequent use, you can actually roll that into the cost of the loan. And so don't be afraid to say, well, gosh, now I got to pay this much more money. No, the VA does that and puts it back into the loan. The funding fee is simply the guarantee of the loan. And so the VA is guaranteeing, in their case, 25% of the value of the loan in case it goes in default. So it's something that is insurance for the lender itself. So it's a little bit complicated in that sense, but it always is allowed to be rolled into the loan.
It's not something you shop for.
It is.
We don't shop for this. So when you're asking, oh, hey, would this be a little cheaper, or can we pay different? It's the same for all of us, because this is a fee that is basically a financing fee by the VA. But you can pay it out of pocket, or you can put more money down, 5% or more, and you can start reducing the amount that you're going to pay on the funding fee as well. So enough about the funding fee, but excellent program as far as zero down a program goes. So what's some other things that we need to know if we're going to get a VA loan?
So, we just talked about the funding fee, but there's a huge advantage in other areas beyond the zero down payment. One of the big things is they tend to have much better rates on average. I mean, the market fluctuates, but on any given day, they try to have more rates that are competitive. In addition, with their debt to income calculation, they tend to be one of the most liberal programs out there in terms of allowing you to spend the most amount of your monthly income.
Absolutely. You can be in some serious debt and still get yourself a VA loan. It's no problem. Real good.
Yep.
Yeah.
And they tend to be flexible in underwriting too. They can look at collections and, say they understand and,
sometimes a little more common sense used there. Sometimes. Not in all categories, but sometimes, yes.
Because
definitely
again,
debt to income.
The VA is trying to help a veteran get into a home. And so their whole idea is they want to help you. This is here as a benefit to our service members.
Absolutely. And when we're doing a VA loan, there is, like all programs have their different appraisal done. With the VA appraisals are actually ordered through the VA appraisal system. They have an approved list of appraisers that are used on there. And so we order the appraisal through them. They assign the appraisal, who the appraiser is, to us, and then that appraisal is done. And then when the appraisal is done, they issue that to the VA, and then underwriting will pull the appraisal and issue what you call an NOV, a notice of valuation, which is then your appraisal. So it is done on a rotation basis, not something that we can pick or anything like that, and it is all done through the VA.
Really, there's mostly benefits with the VA loan. We've talked about the funding fee, which you may consider that a drawback. The only thing we have to be a little bit careful about when it comes to a VA loan is something called residual which means how much money you're going to have left over after paying your expenses. And one of the major things is childcare. If you have children that are of the age that need childcare, we actually have to count that in your monthly debts. So that's something that make sure you're super honest and open about what you're paying for
Yes,
childcare.
if you have a child under 12 years old, it's going to be asked and actually asked to explain why you're not paying it if you're not. So that is a big VA one. And man, some of this childcare stuff we see,
It's not getting
it's
cheaper.
a whole nother mortgage on top of it. So really important to consider that and just be upfront with your loan officer as well if you are paying childcare, so that can be included in your debt to income ratio when you're looking to get qualified for a property as well.
We hope we shed a little bit of light on a VA program. If you have any questions, please don't hesitate to reach out. Until then, thanks for tuning in, and we'll see you next time. This podcast is sponsored by Residential Mortgage, LLC, NMLS numbers 167729, 196-576, and 1820404. Equal Housing Lender.